See, the discussion is going to be on mutual fund areas. I hope that all of you will be knowing as what is mutual fund. Mutual fund is a place where small investors, along with big financial institutions, may join together and pool the resources which will be made available to the mutual funds to be invested in the most effective way, so that the returns are maximized. So that is the basic idea behind this mutual funds. The principle of mutuality will ensure that there is no taxation that is involved. That is the reason why returns on mutual funds will not normally be taken for taxation. Now let's just go through as how this NAV is computed. NAV is computed based on mark-to-market basis. By taking up all their investments at the latest market prices. Then that will be divided by number of units that will enable you to find out NAV. So if you look at the purchase and sale of units, that should always be done through the mutual fund only. Mutual fund will buy and sell at their NAV only. So you find that trading of units will be done in such a fashion that the mutual fund is involved. Every purchase and sale that is being made, it is done only through mutual funds. Therefore, it will have the characteristic feature of primary market. Whatever money that investor is bringing in to the market, it will go to the mutual fund. Only in the case of initial public issue, money invested by investor will go to the company. Thereafter, buying and selling is carried out in the secondary market between two investors through broker. It will be done, and money will not flow into the company, and therefore we call the other market as secondary market. Whereas in the mutual funds, units will be bought and sold by the mutual funds from the investors directly. So therefore, it is carried out in secondary market where through broker you can do, but it will reach ultimately the mutual fund, and the price will be based on NAV only. So NAV is so important in the case of mutual funds. Now let us just see as how NAV is computed on a particular day and how NAV is undergoing a change on account of a transaction that had happened on one of those days. Now let's just go through this problem. On 1st of April, Fair Return Mutual Fund has the following assets and prices at 4 p.m. Shares of 5 companies, number of shares and the market price they have given, and the number of units that you have. Calculate NAV of the fund on 1st of April 2009. Assuming on 1st of April 2009, Mr. X, high net worth individual, HNI, sent a check of 50 lakhs to the fund, and the fund manager immediately purchased 18,000 shares of C Limited, the balance held in back. Then what will be the position? Now, the following day, on 2nd of April at 4 p.m., the market price they have given, and what will be the new NAV? So, this question is a study material question, and it is there in our RTP also. Now we are expected to answer for how this three can be handled. Now, since computation is involved, I would like to use Excel. A lot of multiplication, totaling order to be conducted. So I felt that it is better that we do through Excel. So we understand that the companies are, this is answer NAV for 1st April. Companies or A, B, C, D, then E. Then number of shares. Number of shares are 10,000, 50,000, 10,000, and 1,30,000. Then market price per share, they mentioned as 19.7. Then 482.6. 264.64. 264.4. 674.9. 25.90. So market value of investments. So number of units, they have mentioned it as 8 lakhs. NAV is going to be so it is 119.04. $119.05. This is answer for the first part of the question. What is that in the second part of the question that you have? Mr. X had sent 50 lakhs. With that, they have bought 18,000 shares. So, amount available for investment. Lakhs. Market price per share of which company share they want to bring out investment? C Limited. C Limited 264.64. They bought 18,000 shares. Invested balance held in bank by mutual fund. Out of 50 lakhs, they have invested only this much. Balance held in bank by mutual funds. Third question. What is the third question? So the same format I got to use. Number of shares 10,000, 50,000. Here it is going to be 10,000 plus 18,000. It should be. And these prices will be different. So this is NAV on day 2. Second April. So number of units increase. How do we work out? This is the 50 lakhs divided by 119.5. So you can say 42,000 units. So rounded to 42,000. Now what will be the total number of units for 2nd April is going to be 8 lakhs plus 42,000. Now let us just look into the market price per share. It is 20.3. 513.7. 290.8. 671.9. 671.9. 44.20. So NAV is 128.8. But it is wrong if we do like this way. We have got to take up bank balance also. Bank figure is this. So now it is not 8 lakhs, it is going to be 8,42,000. So these are the corrections that we are getting for it. It should run through the mind. Now let's just see. 119.05 that we have got. So 240, 800, that means rest of which are all correct only. So this one, 8,42,000, 122.08. Matter over. So you should be in a position to run through the problem as how the solution has got to be developed. So this is the way I feel like if I were to be given a chance like a student, I will work out like this way. And now let us just take up on to question number 2. So there are 2 mutual funds, namely B Mutual Funds Limited and K Mutual Funds Limited, each having close-ended equity schemes. NAV on 31st of December 2014 of equity schemes of D Mutual Fund is 70.71, consisting 99% equity and remaining cash balance. See, in fact, before I could forget, let me tell you, this question was asked in December 2021 examination. And that of K Mutual Fund is 62.50, consisting 96% equity and balance in cash. Following is the other information. I have solved this before that examination also. This we have it in our workbook, in our classroom also. We have just worked out. You could have just seen in the lectures this problem we have handled. Now the question is, the following is the other information. Oh. The information there is incomplete. Don't worry, I will make it complete because they have mentioned it as following of the other information you have, but we don't have that information at all. See, now don't worry, I will pick it up from Institute Study Material. It's not there. This problem was there. Yes, it's there. Now you can see that this is the problem. The following is the information that is pending. Are you seeing that? Following is the other information. You don't have it at all here. Okay. Let me download that. mutual fund study material. Yes, this is the problem. Say there are two mutual funds up to this Sharpe ratio, trainer ratio, standard deviation. There is no change in the portfolio during the next month. An annual average cost is 3 per unit for the scheme for both mutual funds. If share market goes down by 5% within a month, calculate NAV after a month for this scheme of both the mutual funds. Consider 12 months in a year and ignore number of days for a particular month. See, how do we crack it? Now let us just crack this problem. Of course, I expect you people to have some knowledge about what is beta, what is this ratio and all that. We have equity scheme, standard deviation, they have mentioned. This is question number 2. We have two schemes. One is D mutual fund and K mutual funds. Right. So they have given you Sharpe ratio. Sharpe ratio formula is the expected return minus risk-free return divided by standard deviation. They have given you the number as 2. 2 is equal to the expected return minus risk-free return divided by the standard deviation, which they have given us 11.25. So for the other one, for K mutual fund 3.3. 3.3 is equal to the expected return minus risk-free return divided by 5. So excess return we can arrive at, which is nothing but the expected return minus risk-free return is equal to excess return. How do we find out? 2 into 11.25. 22.5. How did you get? 2 into 11.25. 3.3 into 5. 16.5. 3.3 into 5. This is called as excess return. Correct? Now, for trainer ratio, 15 in both cases. 15 is what you get as both. The formula for that is excess return divided by beta. So excess return is 22.5 divided by beta. Here 16.5 divided by beta. So now you can arrive at as beta. So beta is equal to 22.5 divided by 15, which is equal to 1.5. Here beta is equal to 16.5 divided by 15, which is equal to 1.1. So beta is a sensitivity of that particular fund for a given change in the market. They have mentioned that in a month's time, share market went down by 5% is what they have given. Correct. So this is working note number 1. So scheme working note number 2. In this scheme, D mutual and K mutual. Market change 5% down. Beta in this case is 1.5. So what is that down in this scheme? So if market has gone down by 1, this will go down by 1.5 times bigger. So 5% into 1.5, which is equal to 7.5% down. 5% down here would mean here it is 1.1 times. So 5% into 1.1, which is equal to 5.5% down. So this is going to be their fall in equity shares. Now working note number 3, where the scheme is D mutual and K mutual. In this, the total is NAV total is 70.71. NAV total is 70.71, consisting of 99% and remaining 1%. 70.71 and it is 62.5. So percentage of equity is 99% and 70.71 into 0.99. So which is 70. How come? 99% into 70.71. That 99% is given in the problem. So this is equity and this is cash. Cash is going to be 0.71. How come? 70.71 minus 70. Next one is 62.5 consisting 96%. 0.96 into 62.5 is going to be 60 and 2 rupees and 50 paisa. 62.5 minus 60. Correct. Now this is spot. Working note number 4. 1 month later, scheme B mutual and K mutual. So your spot figure changes under new value, which is 70 previously. What is that they have mentioned? 7.5% it will fall. 7.5% into 70. 70 into 0.075. That comes to 5 rupees and 25 paisa down. If I down there, by taking up 70, it is going to be 64.75. In this case, when it is 60, it is 5.5% on 60. It is 3.30, 56.70. This is for equity. Correct. For cash, spot, change, and new NAV. As far as cash was concerned, it was 0.71. Here for cash, they mentioned annual average cost is 3 per unit. Annual average cost 3 per unit. Whereas this change they are expecting a month. So 3 divided by 12. 3 rupees per 12 months, that is 1 year, would mean how much is that per month? Change per month is 25 paisa. That means I should spend, because they say no change in the portfolio in the next month, an annual average of 3%. Why they say no change? That means I have not increased the portfolio, nor I reduced the portfolio in terms of number of shares. I'm keeping the same stock now for the sake of convenience, and average annual cost of 3 rupees per annum will be incurred. That means 25 paisa per month will be incurred. So 0.71 minus 0.25, it is going to be 0.46. Now these two I got to add and bring out here, plus 64.75. When I get, it is going to be 65.21. So 64.75 plus 0.46. That is the way we will arrive at. That is the way we will arrive at. Same thing in this case also. So it is 2 rupees and 50 paisa, 0.25, 2 rupees and 25 paisa. So now to make it different, so this 56.7 plus 2 rupees and 25 paisa, that should give you 58.95. So 65.21 and 58.95 is the final answer. So now let us just check up. So uh, 65.21 and 58.95. We are into the third question. The following particulars relate to yes fund schemes. Particulars: investments at cost, pharmaceutical companies 158, construction companies 62, service sector company 112, IT companies 68, real estate companies investment, there is real estate companies 20. Investment in bond fixed income, listed bonds 8,000, 14% bonds of 15,000 each 24. Unlisted bonds 14, number of units outstanding 8.4, expenses payable 7, cash and cash equivalent 3. Market expectation of the bond is 8.842%. The fund has incurred the following expenses: consultancy and management fees 520 lakhs, office expenses 180 lakhs, advertisement expenses 48 lakhs. Then particulars relating to each sector: index on purchase date, valuation date. They are given all types of companies. So calculate the net value added, net asset value of the fund. Calculate the net asset value per unit. Determine the net return annualized if the period of consideration is 4 years and the fund has distributed 2 per unit per annum as cash dividend during the same period. Calculate figure in rupees in crores up to 3 decimals. Now they have given you this information on a particular date. Let us understand that it is date of purchase only. So on a valuation date, which is some period, the index resulted like this way. So what they are trying to convey is that, so this pharmaceutical companies investment of 158, that point of time, the index could be 300. This index is 500. So indexation process for the purpose of finding out cost of indexation in the case of capital gain, same thing only. So that particular cost multiplied by the index on the day of valuation divided by the index prevailed on the date of purchases. So that should enable you to find out as what is the increased value. And this way, for all the 5 industries, based on the indices that they have given, we should be in a position to arrive at the value. Okay. So regarding bond and all that, they would have given some information. What is that? So investment in bond fixed income, listed bonds, 8,000, 14% bond of 15,000 each. So if you multiply 8,000 with 15,000, you will be getting 24 crores. Now let me just check up 8,000 into 15,000. You get, oh, not to the extent. So you are just getting, in terms of lakhs, you are getting 1,200. Say maybe some other bond also, maybe there. Let us just wait. Say normally a chartered accountant, when they are provided with the information, we will cross verify. So it's not working. So if you take up this, comes to 12 crores, but it is given as 24 crores. Let us just ignore for time being. Unlisted bond 14%. Then number of units 8.4. As how value in rupees also in crores, number of units also in crores 8.4. Then expenses payable, that is to be deducted from the total value. Cash and cash equivalent should be added. And market expectation on the listed bond is 8.842. So therefore, whatever income that you get, when it is divided by 8.842%, it should give you the value of the bond. Only for that purpose they have given. That is what we should understand. And during that particular period, so much of money that they have spent, that has got to be deducted from the cash, and the remaining cash is what we have to take up. Now you are expected to total up all the amount of investments. So when unlisted bonds, they have just not mentioned anything about that. So the fair basis could be same value only. So take up all the index to bond, and this bond of, now let me just pick it up, 24 into 0.14, the whole divided by 0.08842. So that gives somewhere around 38 crores. So that can be taken up. Unlisted bond same. Number of units undergoing no change. So we can find out the net asset value of the fund and divided by number of units as they given with no change in the units. Maybe it's a closed scheme, close the end. So there will be no change into it. You can arrive at NP, that is NAV. Determine the net return annualized with the period of consideration is 4 years. In each one of those years, 2 rupees they have given as dividend. So what could be considered as income on an annualized basis? Yield for annualized basis would be, so the change in the NAV plus 2 into 4, so much of income divided by the initial investment that they have made, multiplied by 12, the whole divided by 48 into 100, that should give you annualized yield, or what you can call it as net return. Now let us just see, same thing they have just done, 158, sorry, yes, 158 multiplied by 500 into 300. That way, each one they have worked. Listed bonds, as I told you, there is some error there. So we will ignore that. We will take up whatever 24 crores that they have. On to that, we will apply 14% divided by 8.842%. You should get 38. Unlisted bond, same value, nothing they have just mentioned. As far as cash is concerned, 3. And expenses payable, they have taken up. They are not deducted annual expenses there. So which information is at the very initial, that is when you just have it on a closing date, 481.02. So NAV of the fund divided by number of units should give you that number of 93. Net return. So investment in share 420 crores, bond 38 crores. So how come we are just getting all that information? So initially, whatever investment that you made. Now let us just take the calculator, 158 plus 62 plus 112 plus 68 plus 20. 420 in investment. That is what they have reported there. 38 in bond. 38 both listed and unlisted. 478. Number of units. At the initial stage, it was 54.52. The difference between the two is capital gain. 4 years, 2 rupees, 46.42. This is what I was just telling you. This is the way we have to arrive at. Now, whatever we have just seen, you would like to put it. But the problem is they have not considered one item totally. The fund has incurred the following expenditure. And nowhere they have just mentioned about this. So therefore, we are also ignoring because it has got no, what should I say, place where to treat. Now let us just take up. I will demonstrate to you as how it can be worked. Industry. Investment. Index on day of purchases. Index on the day of sale or evaluation. Then 4 years end value. What is that? What are the industries? Pharma, real estate, service sector, sorry, construction company, service, IT, and real estate. Initial investment. $158, 62, 112, 68 and 20. $300, 275, 285, 270, 265. Index as on the date of evaluation. 100, 490, 500. So here, around this figure should be multiplied with 500 divided by 300, 3. Listed bond. Listed bond 24 crores. Here, how this change we are going to make? 14% into 24 crore divided by 8.842%. 8.842%. 14% into 24 into 0.08842 comma 3 round. I think we have this one from somewhere. This is divided by 3. Unlisted bond. Okay. Assume no change. Then, so expenses payable 7. So cash 3. Expenses payable 7. Minus 7. Because I got to deduct that. So what will be the first question? Net value added at the fund. Net value added of the fund. Okay. Then number of units. Number of units 8.4. NAV per unit. $92.97. Let me just check out. 92.97. So here 781 point. So somewhere some wrong. So 1 crore difference is there. Let me check out. 263 right. 110.43 right. 196.49. 129. 33.02. 38.14. 3, 7. So I do not know Microsoft or PDF, which one is right, I do not know, but it is all working out that. So 92.97, you may round it up to 93 as we have just done. Okay, see, I don't find any difference at all. So net return. So like this, I want to make a note here. 458, 8.4, and like this, I'll get to find out 54.52. 54.52. So annualized. So dividend for 4 years. 4 into 2, 8. Appreciation is this minus this. So return is sum of these two. Investment what we have made was 54.5. So annualized return is equal to income divided by investment to 12 divided by 48 into 100. Annualized return income is 46.45. investment is 54.52. This divided by this divided by, sorry, multiplied by 12 divided by 48 into 100. So Even 21.31 marginal here. So this is the way we are expected to carry out, and expenses incurred by the fund is already taken arrival of closing cash balance. Hence, same is ignored for our computation.